It's another beautiful Monday morning. Welcome to International Business News. I am Lekan, Onabanjo, and we're starting off from Europe. Britain, under Prime Minister Boris Johnson, is running into the biggest headwinds it has faced since the 70s, heaping pain on an economy still reeling from Brexit and the pandemic. Suffering from unprecedented shocks in recent years, the nation is succumbing to more intractable problems marked by slow growth, surging inflation, and a series of damaging strikes. The result is a plunge in consumer confidence that analysts warn may lead to a recession. While growth is on track to lag most major economies next year, inflation is also on the rise. Consumer prices surged by 9.1% in the year through May, the most for 40 years. The Bank of England expects inflation to accelerate again when energy bills are allowed to rise in the autumn, reaching more than 11%. Now, Asian economies that have shielded their citizens from surging energy and food prices through subsidies and other fiscal support are being forced to narrow their aim to the most needy to ease the strain on their pandemic-battered budgets. Indonesia and Malaysia are refocusing subsidies to ease the financial burden after 2 years of big spending to weather COVID-19. The Philippines' incoming president has proposed a similar plan, while Thailand is asking its oil industry to help fund fuel subsidies, and even India is warning of the need to rein in some spending. China remains an exception, given muted gains in consumer prices. Winning fiscal support couldn't come at a worse time for the region, and inflation is yet to peak in Asia, according to economists Nomura Holdings Incorporated, which sees risks from global supply chain snarls and protectionism, as well as continued COVID-19 lockdowns in China and weaker harvests in India. That threatens disposable incomes and consumption, which are already under pressure from economy cooling, inflation fighting, set to be interest rate increasing. Now, France's central bank governor, François Villeroy de Gallau, has suggested that the recent happenings in the cryptocurrency markets, characterized by massive sell-offs, have pushed people to trust more in banks than digital currencies. Speaking during a session at the World Economic Forum, Villeroy pointed out that the shift might be due to the nature of private cryptocurrencies that he said don't foster trust. Consequently, he noted that citizens might seek to align with products that promote trust, like central banks' digital currencies. According to the governor, cryptocurrencies are unreliable because they lack an entity that is responsible for their value. In this line, Villeroy noted that the trust issues would continue and likely accelerate the development of CBDCs. Now, the FTSE 100 made a strong start to the opening session of the week as the tentative rebound from the global sell-off continued. Inflationary worries were pushed to one side after a strong start in Asia earlier that mirrored the performance of Wall Street on Friday. If the cooling in natural resources prices helped quell fears over the commodity cost portion of the inflationary equation, it has had a knock-on negative impact on the UK blue chip index, with its weighting towards miners and oilers. Scottish Mortgage Trust, one of the UK's biggest investors in Silicon Valley, rose by 2%, mirroring the jump in the tech-heavy Nasdaq on Friday. Now, one of the biggest international business stories right now is the news that Russia has slipped into default for the first time in over a century, and Tolu has the details after this break.
Russia now looks set for its first sovereign default in decades, as some bondholders say they have not received overdue interest on Monday following the expiry of a key payment deadline a day earlier. Russia has struggled to keep up payments on a 40 billion, around 37 billion euro of outstanding bonds since its invasion of Ukraine on February the 24th. This, as sweeping sanctions have effectively cut the country off from the global financial system and rendered its assets untouchable to many investors. The Kremlin has repeatedly said there are no grounds for Russia to default, but it is unable to send money to bondholders because of sanctions, accusing the West of trying to drive it into an artificial default. Now joining me is Ifeanyi Udeh, analyst at Nairametrics Financial Advisory Services. Ifeanyi, welcome to Business Edge.
Hello. Good morning.
Good morning to you, Ifeanyi. So Russia has now missed this deadline of Sunday night in order to be able to pay back its Eurobond interest payments. What's the likely impact for Russia's economy, if any?
Well, this is actually a historical moment because the last time something like this happened was over 104 years ago. Now, this is particularly tricky because it's not as if Russia doesn't have the cash. In fact, the financial minister has said that Russia has the cash, but because of the sanction imposed by the West, they are not able to, use the funds and the dollars they have in their foreign bank accounts to actually pay this interest. They have first tried to say they want to pay in rubles, but as part of the contract of the bond, there is no clause that allows payment in rubles, which leaves the world in a dicey situation. So, as far as the impact for how to affect the Russian economy is that Russia will be seen more as a riskier asset, like Russia government bonds, that is, because, once you miss your interest payments, investors start getting scared and saying, is this a plausible solution or plausible investment to have? And investment might be seen to withdraw more. We have seen major companies leave the Russian economy and Russia trying to gather back after hitting an all-time inflation of 17.14% before coming down to 17.1%. So we are definitely going to see a little bit of economic shock impacting the Russian economy because of their lack of funds from the Western sanctions. But we are seeing movement from the Russian currency that can tell you that this might actually be weathered.
So beyond Russia and the impact felt internally, what are we looking at in terms of the impact on the global economy? Because we've seen what's happened with higher food prices, higher fuel prices, how things have played out even as we're trying to recover from COVID. So what do we need to be prepared for?
Well, the global economy is entirely linked, and we are seeing that these sanctions and the continuous war in Ukraine are having bullish prices on oil and pushing inflation to skyrocketing level. The central banks of the world are responding to that by cutting interest rates. And we are expecting, and most analysts have projected that the United States is going to enter a recession come the next time they release their GDP data. Combining all these circumstances and putting the continuous war in Russia and Ukraine, there's no good news for Nigerians and the world at large. Until we have the ease of global tension and a little bit of economic recovery, particularly by the global superpower, we still need to be tightening our belts and be bracing ourselves for what's to come.
All right. So we know that Russia has said it was willing to pay in ruble and that was rejected. The country had readied itself for the long-term payments and offered that payment in terms of its obligations. But it seems the world, or particularly the European Union, is bent on these sanctions. And questions are now being raised as to whether or not it's actually worth it. So a wearing down of Russia's ability to sustain the war, or for its debts, which are about $40 billion to be paid. In the long run, when you see how all of this is playing out, do you think the sanctions are worth it?
Well, it's hard to tell. Most analysts will tell you that we are entering a Cold War 2.0, but the sanctions are definitely biting on everybody. And saying the sanctions are not worth it is saying that the Western powers should not act on their conviction. Even if they are not supporting Ukraine by military forces, they still need to act in such a way that they deter advancing superpowers like Russia from gathering more territory. So it's really a dicey situation, but the goal that economists have tried to pull out in sanctions is to give the maximum impact to the Russian economy in such a way that it makes it more difficult for Putin to advance in order to bring him back to the negotiation table. So this is actually a negotiation tactic. So we know that these defaults will definitely impact Putin's ability to borrow, and impacting on Putin's ability to get funds will mean it could probably have a military impact on his advancement. So I don't know whether it's enough, but I just hope the tensions ease down and we start looking at a little bit of global normalcy.
All right, so finally, Ifeanyi, before I hand you over to Lekan, we know that Russia's ratings are more than likely to be downgraded by the ratings agencies because of this. But what are the options available to investors and bondholders that are now unable to recover their monies from Russia in light of this default?
Yeah, so it's a dicey situation for investors. One option would be to wait and see. The wait and see approach would be to see how Russia responds to this and see whether tensions die down in a couple of months. And others would be trying to know, which might be a little bit tricky given the sanctions. So this actually deters investors from looking at Russian bonds, and they are always moving. That's why you see the dollar index is gaining new highs and trying to is up 2.21% as of yet to date, and most investors are looking to hold safe haven assets. So it's really hard to say, and we are actually moving in historical times and troubling times. We are seeing the stock market drop, the crypto market drop, and we are definitely seeing the bear market move across water. What investors are looking at are things that will be safe and things that we need to use to project long term.
Ifeanyi, thank you so much for giving us some details on this story. It's one that we'll be watching very closely. I know you're sticking around for Money Monday with Lekan, but that'll be coming up after the break.
Okay, thank you very much. All right.
We'll be wrapping things up with NC4 to watch starting in the northern parts of the continent, I beg your pardon. In an effort to reduce imports, Egypt has contracted to buy 180,000 tons of Indian wheat. Zimbabwe's central bank is set to hike its key interest rate to 190%. South Africa's Eskom says a stage 4 power cut continues amid labor strike. And weekly tea auction records more decreases in prices. And that's the show for today. Don't forget to follow us on social media. We are at News Central TV. Head to our website and, of course, download our mobile app on Play Store and App Store. Until next time, do have a good one.